for founders, angels, and employees with Sale Kwan and Dhirani Pitts and Stanford Angels and Entrepreneurs United. Format today, we'll start with speaker introductions, followed by frequently asked questions regarding startup equity. Then we'll open up for audience Q&A, followed by closing thoughts. Welcome to our speakers, Sale Kwan, a partner at Cooley LLP, and Dhirani Pitts, Director of Capital Markets at Carta. Sale, would you like to introduce yourself?
Sure. Thanks, Sheila. And as Sheila noted, I'm a partner in the Emerging Companies and Venture Capital Group of Cooley LLP. And for those of you who are not familiar with Cooley as a law firm, just wanted to give you a brief intro to the firm and what I actually do. The firm was formed like 102 years ago in San Francisco, and best known for the firm that formed the first venture capital partnership on the West Coast in the 50s. Thus, we have deep roots in the venture community. So we're one of the most active firms in venture financings. So last year alone, we advised on more than 1,300 venture financings, and also one of the most active firms in the IPO space. And we've advised on high-profile IPOs, including those of Uber, Zoom, Snowflake, and Snap, and many more. About myself, I'm a pure-play emerging companies venture capital lawyer. So what that means is I spend half of my time working with founders and helping them organizing their companies, raising capital, and doing strategic transactions until they eventually go public or get sold. And I also spend half of my time working with various venture capital investors, angels, and corporate investors, and I help them with their venture investments.
Delighted to have you join Sale. Dhirani?
Hello, thanks everyone for having us here. My name is Dhirani Pitts. I am currently working at Carta. If you're unfamiliar with Carta, we are basically an electronic registrar of shares or equity for many of the venture-backed companies, not just in the Valley, but all over the world even now. I currently work in a role in sort of financial education, or what we're calling employee financial services, where we are tasked with providing financial advice to employees at some of the many companies that are on our platform. Prior to this role, I worked in the capital markets group, specifically working on secondary transactions. Tender offers is probably the one that you're most familiar with, but other type of transactions where companies sponsored the ability for employees, early investors to actually sell their shares to either outside investors or even being bought back by the company. So very familiar with that process, and it has been ramping up a lot over the last year or two. And additionally, I also spent some time in customer success at Carta, working with late stage private companies on how they reflect their equity in Carta. So can give a lot of examples of some of the do's and don'ts of what people can do, especially when they get to that last stage where they're looking towards liquidity in terms of a transaction or even thinking about going public. Other than that, I, of course, am a Stanford alum and spent the most of my career in wealth management, basically advising people on what to do with their own personal equity compensation. So happy to be here with y'all today.
We're thrilled to have you here, Dhirani. I'm Sheila Pruva, and I'll moderate today. I have an MS in computer science from Stanford. I'm founding co-president of Stanford Angels and Entrepreneurs United and also managing partner of Prime Row Ventures. Previously, I was a startup operator in cybersecurity, and I've advised a $500 million VC fund and top executives on M&A deals in Europe and North America. Some quick reminders before we get started. Cooley LLP, Carta Inc., Stanford University, Stanford Alumni Association, and Stanford Angels and Entrepreneurs United are not a tax, financial, or investment advisor. This presentation is only intended to provide a general, non-exhaustive overview of the covered topics and is not intended to constitute legal advice to you in your specific situation. For such advice, please consult with your own legal, tax, and financial advisors. Now, let's dive into frequently asked questions. Startup equity basics. What different types of equity are commonly issued to founders, employees, and investors by a private company?
Happy to go first on this one. So Equity is called differently based on depending on what kind of company you're talking about. So for example, for limited liability companies or LLCs, equity is often called membership interests, units, profit interests, and all kinds of other names. But for the purposes of this session, I'd like to focus on corporations because corporations are the predominant norm in the VC space. And they're mostly organized as Delaware C corporations for certain benefits, but the biggest benefit being that's what the VC investors are expecting. For founders, they typically buy shares of capital stock, usually in the form of common stock. It usually comes with standard voting right. They often get their shares subject to vesting, and vesting simply means the unvested portion would be subject to forfeiture. So for example, if you're buying 10 shares subject to vesting over the course of 4 years and you quit after 2 years, then essentially half of your shares would be vested at that time and the other half would remain unvested. Because your unvested portion is subject to repurchase by the company at cost. So it is usually, investing is designed to incentivize or motivate founders and employees to stay with the company. It's a very common retention measure. For employees, they usually get their equity under an equity incentive plan. Those terms are largely driven by securities laws and tax laws. So when you organize a company, you often allocate certain portion of the company's entire equity to a plan. So let's say you're going to issue 10 million shares or you're going to deal with 10 million shares, then you would expect often reserve like 10-20% to the pool. And that pool initially remains not owned by anyone, but that's what you dip into when you try to give equity awards as incentive as employees join the company. In terms of the forms of equity employees typically get, in the very early stage, it makes sense to buy stock directly under the plan. And they are often called restricted stock awards. They're often bought because when in the very early stage, the per share price is very low. So that's why founders can buy, but essentially they pay like $5 for 5 million shares or something like that. So the employees can take advantage of that low price initially. And once the company is valued high and there is going to be a meaningful market value to the shares, then companies often switch to option grants. So option grants are essentially contractual rights to acquire shares of capital stock of the company at a certain price. And under US tax laws, they're either viewed as incentive stock options or ISOs, or non-qualified stock options or NSOs. And this goes beyond the scope of this presentation, but incentive stock options come with certain tax benefits. When the company progresses further and its equity becomes more and more valuable, then the value of option is not as attractive because you're getting like, shares, but it's exercisable at like $60 per share or something like that, then it's not a great incentive tool. So late stage companies or pubcos usually switch to like what is called restricted stock units or RSUs. So RSUs are essentially like contractual right to receive shares upon satisfaction of certain conditions. So they're often called vesting conditions. So when RSUs vest and then it settle, then they settle into shares. So RSUs turning into shares, and there's no exercise price. That's what is frequently employed by late stage companies or public companies. You sometimes often see phantom stock, and those are kind of rare. That's essentially like contractual entitlement to receive a contingent cash bonus. And the value would depend on certain parameters that is defined in the transaction. And often they are subject to a hurdle or something like that. But the point is that it's quite rare in the US and in venture-backed corporations. And it's to some extent more popular in foreign countries or LLCs where standard equity grants are not going to work. For investors, angels and VCs and corporate investors, the predominant form of equity they take is preferred stock. And preferred stock is essentially shares of capital stock, just like common stock, but it has some preferred features, such as liquidation preference or preferred dividends, and so on and so forth. In the early stage, investors often take convertible equity as well. And the most popular form of convertible equity these days is SAFEs that are kind of essentially designed by Y Combinator. And that's intended to replicate what was more popular before SAFE came along, which is convertible notes. So conceptually, what they are is essentially money advanced to the company, and with the expectation that that money will convert into shares when the company goes along and raise their preferred stock financing. The reward for coming in early is that they would get a discount. So if I give you $1 million now, but it's such a small round, it's too early, so I don't have enough information to value the company, and I don't think this transaction is big enough to involve like legal advisors to negotiate terms around preferred stock and so on and so forth, then you would just say, here's the money, but I just need to make sure when you raise your price round, I get 20% discount. So that's roughly the concept of convertible equity.
Excellent. Thank you for breaking that down, Sale. Dhirani, for an early employee, how should one think about the value of options?
I think this is always a tricky one to answer because options are very difficult to, I'd say, value in their rawest form. So some questions that you may want to ask if you do receive an equity offer is one, don't worry specifically about the number of options or number of shares that you've been actually offered, but maybe focus on, hey, what percentage of the company does this represent, right? Because 10,000 shares could be 1% of the company somewhere, and it could be 1/100th of a percent of the company, so and in a different place, just based on kind of where the value of the company is. Other questions to try and understand is this commensurate with people at this stage? And when you say an early employee, what is that percentage that early employees tend to get in this role, whether it's a lead engineer role or a role that's specifically like heading up a sales organization? Those are the type of metrics that you'd want to benchmark yourself against and be able to bring data to the negotiation to make sure that you're getting a fair offer. When you're an early employee, it's often said that the value of the equity you receive it's in theory, it's very negligible in terms of if you look at it from a sheer expected value, right? When we think about venture-backed companies, let's say 1 in 15 of them actually make it. So if you're actually doing the just math on that and the probability of success versus the value that it is, the value is really low. So if you have a strong belief in kind of the vision of what's going on and you feel like you're getting a commensurate value in terms of percentage of the company, I think that's the best way to value your equity agreement or your equity offer with the company.
On to control and equity. What's the relationship between equity ownership and control of the company?
So they usually go hand in hand. Obviously, ownership of the company usually represents economic value that you own in the company. And those shares usually come with the right to vote. And the company's control essentially lies at 2 levels. One is at the level of the board, and that board usually represents affirmative control, meaning the board will determine what the company will do. So that in that sense, it's affirmative. Stockholder, the other level that control lies is stockholders, and stockholders have certain statutory rights when it comes to a corporation, and they are not as detailed as board rights because the board will have to approve it almost anything material for the company, including like hiring and firing management and whatnot. But stockholders have certain basic safeguards. So the stockholders elect the board. So that's why board is essentially representatives of the stockholders. And the stockholders also can weigh in when the company is going through a very material transaction like liquidation or a sale of the company and changing the constitutional documents like certificate of incorporation or bylaws of the company. You could, when I said like, ownership of the company and control go hand in hand, if you're thinking about simple company with common stock outstanding and no other, shares of stock, then if you control a majority of common stock, then you essentially control the board, because board is by default elected by the majority of shares. Now, when you're thinking about investors coming in, they would also want to make sure them being a minority is protected adequately. So they negotiate certain protections. So that would be essentially their control as a stockholder, and that's mostly negative control in the sense that they can't make the company do certain things, but they can block it, because the board wants to do certain things, but only subject to the stockholders approving it. So if you were saying, hey, I need to get like, say 80% of stockholders approving this, whoever holds 20% of the stock would essentially have a blocking right, because if they don't vote, you can never reach 80%. So that's sort of how control and equity play out. And there are various ways that you can bifurcate the two. So sometimes you see founders asking for like super votes and investors asking for a class or a series vote to essentially make their blocking rights stronger. So there are many ways you can play with the two concepts.
Ronnie, would you like to add something there?
I think there's a couple perspectives to think about. From the investor perspective, of course, getting as much control as possible is the goal. But in terms of a competitive landscape for companies that are highly sought after and a lot of people want to invest in, and then also what's going on in the market. There may be times when terms and financing are more company friendly, and then there may be seasons when it's more investor friendly and you got to give up a little bit more. So just understanding kind of what's market at the time, and also who the investor is and whether or not it's worth, from a strategic standpoint, maybe giving up a little bit more to get something that investor brings, whether it's a bigger network, whether it's access to other companies in their portfolio that are customers of yours, can be customers of yours. There's a lot of factors to think about versus just how much of a percentage of this am I giving away or am I going to get in a financing. So that's kind of thinking about the investor side. From a founder side or someone who's raising capital, I think you want to try to understand what the pluses and minuses of different sources of capital are. For instance, safes have become very popular, but I think a lot of people may dive into them not understanding that they can be a little more dilutive than the effort of actually having to go out and raise an institutional round. And again, it's going to vary by what stage of the company you are in and what access you have to capital. But just going into it eyes wide open, I think, is the best way to understand how you want to finance the company going forward and what that will mean for how much of it you'll own.
What are common protections for founders and investors?
It's a great question, and lots of people take interest in this topic because as complex as it is quite important. So initially, when you think about founders forming a company, they start with 100% ownership. I mean, they allocate certain things, as I said, to the plan, but the rest is owned by them. So they essentially have a vast majority of shares right off the bat. So, and those shares essentially elect the board. So there isn't a whole lot of protection that is needed for these common stockholders because they represent a majority for a standard company. When you're thinking about investors, on the other hand, they come in, but usually in the early stage or Series A or B, they take a minority position. So if you do not provide for specific protections, then you'll be outvoted on everything. So that doesn't make a whole lot of sense for investors. So and also they're not necessarily aligned with founders in every situation because what they provided is actual capital versus founders typically provide a little bit of capital sometimes, but mostly services. So their tax basis is usually very low, whereas investors came in at a meaningful valuation, then they have some anticipated ROI that they need to achieve and return to their LPs. So the way investors protect themselves is primarily by providing for class voting. So as I said, investors typically take this form of equity called preferred stock. So to the extent you can build negative control in the way that if the company were to sell, for example, you not only need to get what is statutorily required for that transaction, but also you should get a majority of preferred shares. In which case, because preferred shares are all held by investors for the most part, you're essentially giving investors a say or a block on that transaction. So that's how investors as a minority still get themselves protected. They're not going to usually control the board in the sense that they appoint a majority of the board members, but oftentimes they also want to make sure some portion of the board is allocated to them as well. In which case, they also kind of achieve that end by providing who's class voting, applying class voting to the board structure as well. So default, as I said, is a majority of shares elect every member of the board for a Delaware corporation. But if you had said, we are going to go with a board of 3, but one of those 3 directors will be elected by a majority of preferred stock, then essentially investors allocated one of the 3 board seats to themselves as a group. So that's how they essentially get protected. And the same idea applies at the board level as well, because you may say, oh, it's just 1 out of 3, so they can get outvoted on everything. So how do they navigate that? And it's usually done in a contractual way. So there is often this stockholders agreement called investor rights agreement. And in that agreement, you typically have a section that says for certain very important actions that the board needs to take, it needs to be approved not only by a majority of the board, but also by the preferred director as well. So that essentially gives the preferred director a blocking right with respect to those select items, which often include like related party transactions, which means if a founder controlled board is trying to do a kind of side deal with founders that is not arm's length, then it needs to be essentially cleansed by a disinterested director, which would be the director appointed by investors. So that's how you build in those protections contractually. People often say, oh, as you raise more and more capital, founders get diluted. So it's not always the case that oftentimes you raised money, but all you could do was kind of not, kind of low valuation, which means you get diluted a lot. So founders lose a majority early on, then how do I protect myself? And the same reasoning applies. So if you were to say out of 3 board members, 2 should be allocated to common stock and 1 should be allocated to preferred, in which case, even if you are a minority, let's say you represent now 30% and preferred holders represent 70%, still 30% holders will control 2 out of 3 seats on the board level. So that's one way founders typically protect themselves. This is completely customary. Now, there could be some more complex ways or complicated ways to make founder protection stronger. And for example, founders often give themselves super voting stock, and it's called various things. You can call it like Class B common or founder preferred. And you can also build in various bells and whistles. The issue with that is that, as I said, you can always have common stock vote as a class. So even if you're a minority, so long as you're going to control common stock, so you're going to have a majority of common stock, then you don't really need super votes. And super votes are not going to override preferred stocks blocking rights. So that's why super votes sound very appealing, but that's not very helpful in many situations, which is why it's not very common. And also, every equity financing, preferred stock financing, investors look at super votes and other voting structure and capital structure And to the extent they see those things as not customary, which many investors take that view, then they can always unwind it. So you initially start out because you have founders at the table and saying, oh, we're going to have everything founder friendly included. So no vesting, and it's going to have super votes 100-to-1 and all the things that you can imagine, only to find out in the preferred stock financing led by a reputable VC would just ask to unwind, peel them off, and we're going to go, customary route, right? So in that case, you just wasted some money on legal advisors and whatnot to set up something that's not customary, so that got essentially undone. So those are the kind of some of the tips around those topics.
Moving to managing cap tables. First, what is a cap table and how do startups typically manage their cap tables? What common pitfalls have you seen?
Your cap table is just basically the roster of all of the equity, who owns it, at what stage they came in to be an owner of your company. And just think of it as the kind of registrar of the equity that you have. To kind of go down a quick history, this used to all be done on paper. It used to be done in spreadsheets. A lot of time spent dealing with your law firm if you needed to update your cap table. Now there's services like the one at Carta. There's several other companies as well that do this electronically. So we've basically, taken the paper and put it in the cloud for a simplistic view. So your cap table really just shows, who owns what percentages, what classes of shares there are split up by, is it the preferred round, the common, looking at your option pool, all of those different ways that you can cut it. Your cap table is that set of data that provides a view into your ownership. In terms of, at a high level, the best advice is, just like any room that you own in your home, you got to clean it every once in a while. Specifically when you have large changes, like a new round of financing or a large round of hiring, right? This is something that you're going to want to always maintain and keep as pristine as possible. Some things that I have seen in the past is people not paying as much attention to the cap table. And as Sale mentioned, when you do have an institutional investor come in, they're going to peel back the onion and they want to understand what's gone on in the past. And if your cap table is messy, these are the type of things that can actually break up a deal or delay a deal significantly. So it is highly recommended that from day one, that is very clear who owns what, right? And in what form, not just as the internal hygiene of kind of the ownership of your company, but it's a signal to the outside that, you have your stuff together and that there isn't going to be some surprise if a new investor comes in and is unaware of who is on the cap table or kind of what percentages are on the cap table, or those types of rights and preferences that Sale talked about are on the cap. All of that stuff is kind of, it's delineated there within your cap table. At least it is at Carta. I know that for sure. So, just think of it as, it's the register of all your equity, and it's worth keeping it very, very pristine and up to date at all times.
What are considerations when making equity grants to foreign service providers?
Because these days people are everywhere, foreign jurisdictions and all kinds of places. The problem is that equity grants are subject to local laws, and those laws include mostly securities laws, employment laws, and tax laws, and they're all different. So for example, for options, I mentioned there are ISOs and NSOs in the eyes of the IRS, the US federal taxation. Now, that's only for the US. So if you're someone in a foreign country, you can't have an ISO because it just doesn't mean anything. You're going to get an NSO, but that doesn't mean they wouldn't have something like that in their own country. So in the UK, they have a tax favorable regime as well, but their requirements all vary across jurisdictions. So all this is to say, if you want to, for an early stage startup, you have to think carefully. Do I want to incur cost? Because there's going to be some cost associated with doing things right in terms of foreign grants. So oftentimes what makes sense is that you probably want to pay cash or something that is not equity. But oftentimes, startups are kind of short on cash and they need to do equity grants. And they want to do that when employees are in foreign jurisdictions. You do want to work with local counsel of that jurisdiction to make sure you comply with local laws. As I said, every jurisdiction is different. So for example, option grants seem pretty innocuous to us, but option grants take a very different form in China or in Russia. And some jurisdictions, it just doesn't work. So you have to come up with something different. So, and every time you try to come up with something different, it introduces complexity, administrative burden, and things can go wrong. Investor counsel may find something that you weren't thinking about. So that's why when you're thinking about granting equity to folks who are in foreign countries, just be careful. It's not that easy. And then you take the right steps, which would be provided to you by your local counsel, by your legal counsel.
Help us in understanding dilution. How does dilution usually occur in a startup, and how should it be viewed?
Yeah, I can share my quick thoughts. I view dilution in two different ways. One is ownership dilution, and the other is value dilution. So ownership dilution is not problematic in my mind. It's completely natural. So you hold 10% of this company, the company issues new shares, and you no longer hold 10% because there are more to the denominator. So that's ownership dilution, and it affects all equity holders for the most part. The way it gets addressed for founders and employees is by refresher grants. But refresher grants are kind of unusual for founders. As I said, founders start out presumably owing 100% of the company. And as the company issues more capital, issues more securities to raise capital, they naturally get diluted. But still, they usually hold enough to align them well with the company. Now, in terms of employees, let's say a high-ranking employee got brought in and got 5% in option grant or some other form of equity. The company goes on and raise a big round with a very low valuation, and then you may get reduced down to 2%, in which case investors and other stakeholders may get worried that, oh, does this person compared to vis-a-vis his influence and his importance to the company has enough in the company, in which case the board can consider refreshing him, meaning like giving him some extra equity to bring him up to whatever level that is deemed appropriate. From investor perspective, let's say you invested in the Series A financing of a company buying 20%. Now in Series B, what you typically have is so-called preemptive rights. It's also called like pro rata participation right. So that's a very standard investor right that just gives you the ability to participate in the round to maintain your percentage. So if you own 10% of the company, then in Series B or whatever new round is called, you are entitled to participate up to 10% of the company. So that's how you protect, investors typically protect themselves from ownership dilution. Value dilution doesn't mean a whole lot to founders because they come in at a very low valuation, whether they bought stock or they got option grants. They're usually getting common stock, which is valued much lower than preferred stock. If you're an investor, you are paying the full price for Series A, let's say $1 per share. And in Series B, the company hit the wall, so it's like half the price. It's a down round, right? In which case, you thought your share was worth $1, and now it's worth only 50 cents a dollar. Then there is a value dilution. So again, it's mostly an investor issue. And the way it gets, investors protect themselves against value dilution is what is called anti-dilution adjustment. And to understand anti-dilution, you have to know preferred stock is convertible into common stock. Initially, they usually convert on a one-to-one basis. But when there's a down round or issuance of equity under certain agreed upon price, then that conversion ratio may be adjusted so it's not one-to-one. It's something higher than one-to-one. So that even if you suffered value dilution a little bit, on an as converted basis, you get less diluted. So that's happens by allowing you to convert your single share of preferred stock into more than one share of common stock. So that's essentially how any dilution takes effect. So that's kind of my 2 cents on the dilution topic.
I'll just add that from the employee perspective, sometimes employees are very concerned about dilution and like, oh, we raised a new round and now I own less of the company, but they forget to do the math of, yes, I own a smaller percentage, but I own a smaller percentage of something that is now valued incrementally higher. So, the fact that dilution does happen naturally as new round of fundraising come in, it's not the end of the world for the regular employees as well, right? Yes, you own less, but you own less of a bigger thing.
Now, Ronnie, you tried to touch on this earlier. When issuing convertible notes and safes, which are simple agreements for future equity, what are some implications for dilution?
What tends to happen is that people just aren't aware of it because it's not happening right away. So what you need to be modeling if you're going to do financing with a safe is you need to be modeling your next round, right? Because the next round is when that safe is actually going to kick in and actually have a bigger effect on how diluted you are. So there needs to be a strategy and thought around when would be the next time that we would actually raise. And you think about things like burn rate, and again, it's a lot of assumptions, and it's very hard to predict accurately, but you do need to have a view because the next round is actually when the safe is going to kick in and really affect what percentage ownership you have. And you don't see it right away when you take that money. So that's important. If you are taking a safe or a convertible note, model the next round, model 2 rounds out, and really use that to really think about, is this the path that I want to take?
Finally, achieving liquidity. How is liquidity typically achieved in private companies?
There are a few ways that is very typical. One is you invest in a company or took an equity position in a company and the company got sold. The company got sold where the consideration received is cash or liquid stock, in which case it's essentially an exit. Sometimes you get acquired by a private company in a stock deal, in which case you get stock in that acquiring private company, but I don't think that's a real exit because you essentially rolled over and became an investor in that company. So a sale is definitely a very well-known way to get liquidity. The other popular option is going public. So going public doesn't necessarily get you liquidity, but you can sell with less restrictions. Sometimes it's freely tradable. So when the company goes public by getting listed on New York Stock Exchange or NASDAQ, in a typical IPO or through a SPAC transaction or direct listing, the company essentially has filed a registration statement. So in that case, there could be other registration rights that trigger, or maybe you don't need registration rights because under Rule 144 or other exceptions to the registration requirement, you'll be able to freely sell your shares. Now, the third one is because not a whole lot of companies get sold or go public, within a couple of years after your investment. So if you're looking for a short-term exit, what happens often is a secondary transaction. And secondary transaction, as it the name implies, is essentially selling your shares to a third party. And it could be the company itself, which is called a repurchase or redemption. But definitely, what's more common is you find a buyer and sell what you have in the company for cash to that third party. So those are the very typical options that you see.
Ronnie, would you like to add, especially on the note of secondary transactions?
Yeah. I mean, I think Sale, differently highlighted the different avenues. I think one thing to note is, of late, there's been a lot more activity in the secondary market. Either by companies that have now made it their business to have investors and try to pick off amounts of shares from employees at a specific company. You may have an investor who's very interested in investing in a private company, and this company will try to get enough employees together to pool enough shares to satiate the demand for that investor. The one thing to think about on those one-offs is generally the company writes its equity plan in a way that allows them to block those type of transactions or to have what's called a right of first refusal on any shares that are being sold. So they could say, well, no, we'll buy them back versus giving you the ability to sell them to a third party, or they could also just say, no, you cannot sell them, and you have to hold them. And there's a lot of reasons for that. When you're a private company, when we talked about cap tables, you have to manage who's on your cap table, and there's actually some administrative cost to adding people to your cap table. And a lot of times you don't want people on your cap table just because they want to be on your cap table. So a lot of the one-offs, I think, though they're happening often, there is a mechanism for companies to kind of block those. Now, there are company-sponsored liquidity events. When you typically see them, at least of late, is during primary financing rounds. So a company raises a large amount of financing. Let's say it's their Series D. And in conjunction with that, the investor may actually have more demand for the company than the company actually wanted to provide shares for. So in a, I guess, less dilutive part of the transaction, the company may say, well, we have existing investors who may want to sell. So we will allow you, new investor, to buy shares from them at a specified price. And those company-sponsored liquidity events, sometimes we're transferring 50, 100. The largest one I've seen to date is like 500 million of shares, worth of shares. So they can be very massive in terms of the exchange of equity from one party to another. But in these instances, they're company-sponsored. They've, gotten approval from the board. And a lot of times it's a way to either get more in the hands of an investor that you want to satiate their demand, or sometimes even bring in new investors that you want to be on your cap table without having the dilution portion of it happen, because the shares are just going from one entity to another. So that's a lot more prevalent now. Just as a highlight of kind of at Carta, like 2 years ago, we did like $1.5 billion in secondary transactions. Then last year we did $2.5 billion. And then this just most recent year we did almost $8 billion. So, part of that is us taking share, but a lot of it is also just how much more activity has been going on in the market. So it's not just the case that you have to wait to IPO or be acquired. Oftentimes these events are happening as a result of investors wanting to get more, or sometimes the company just says, hey, you know what? Our valuation has gone up a ton, and we want to reward some employees by providing them with the chance to sell some of their shares because they've helped produce some of the gains in our valuation and haven't really had a chance to recognize those.
It's time for a live audience Q&A, and we have some questions already. What resources or tools could be used to evaluate an equity package? Example, potential financial value, benchmark relative to the market.
That's a loaded question, to be honest, because equity package can mean many different things. I presume the equity package is with respect to an employee, in which case there are a lot of resources that kind of touch on the form of equity that is customary. So what I would recommend is, from my perspective, there is a website called cooleygo.com. And there's where you can find a lot of articles that provide guidance on what is the kind of customary and how you get your equity, whether it's an option, what is an RSU, and that sort of thing. So that's where you would go to kind of get some, outside view of, how customary what you're getting is. But when it comes to numbers and quantitative aspect of it, as Deroni said, it really depends on the ownership of the company that is represented by that equity award, and also many different economic factors. So when are you joining? Are you joining in pre-series, pre-funded company, or are you joining an established company after its successful Series D company? Obviously, the upside would be bigger if you join early stage company, but the associated risk is also larger in that case. So when it comes to like evaluating a package, I think there are those two aspects. One is whether the form of this package is customary or not. That's where kind of legal advisors or internet sources can tell you how people usually get their equity package. And in terms of the value, that's really case by case decision.
Another question from the audience. Are you seeing the same level of new funding since the public markets have declined? Particularly the audience member is thinking about healthcare companies. Do you have thoughts on that?
If the question is about VC activities, I don't think it got impacted at all. I think public deals like public offerings and SPACs or whatnot, especially SPACs these days, are not very not as popular as it was at one point. But it gets more affected by market situation. When it comes to emerging companies' venture capital activities, venture financing, venture investors are not that short-sighted. They're not focused on quarterly earnings and things like that. And they usually come in understanding what they're buying is illiquid at the time. So I think they're very, more, they look in the long term, and I don't think venture activity has slowed down based on my firsthand experience.
Yeah, I would agree with that as well. And I think, generally what happens in the public market, at least from a valuation standpoint, does tend to reflect itself in the private markets with a little bit of a lag, but I don't think we've even gotten there yet. Valuations and multiples are still very high on private deals. They may come in some as a result of what's going on in the market, but the amount of capital, I feel like, is just greater than it's ever been. It's probably keeping Sale very busy. It's keeping me very busy. It is not slowing down at all. And it's basically from what Sale just, everyone, they're so long-term focused. And if you think about it as a VC investor, if you hit one, that hits the multiple that really knocks it out of the park, it really doesn't matter when you got on the rocket ship, it's still going to the moon. So, at that respect, they're very comfortable deploying capital in most environments.
But one thing I would add to that is sometimes you see some impact on venture activities, but that's because, let's say, founders are from Russia. And I don't have to go further, right? So, and it used to be still is a lot of concern around Chinese founded companies, especially if it's state sponsored. So there could be some regulatory things that are more susceptible to political environment at the time. But in terms of just generally speaking, venture activity has been setting record years every year. So it's growing and it's not getting less crazy.
Next question. What is the typical frequency of employee equity grants and vesting timelines?
Let me answer the first part. Employee equity grants. They're tied to the vesting timeline. So let's start with timing of vesting timelines. The most common vesting schedule right now in the market is 4-year vest with a 1-year cliff. So your equity vest over 4 years, but you don't vest any of it until you've passed 1 year. And then it can vest in more frequent increments through years 2 through 4. So that's the most typical, or I'd say the most common one that we see. There's variations of that, but that's the one that we see the most. In terms of getting another equity grant, you generally would see it during a couple of instances. All things being equal, if your current vesting schedule is coming to an end, you may get what's called a refresher grant. because at the end of the day, the company wants you to always have some equity incentive as part of your compensation. So as you're coming to the end of, year 4 of that typical vesting schedule, you may get another grant that kind of stages and has another vesting schedule associated with it. Other times that you might see equity refreshes as if the external market has changed for hiring and the company wants to kind of re-level people, or determines that, hey, maybe your equity level was great when we first hired you, but the market has changed and now people in your position would receive more equity or a higher salary as well. So a lot of companies are thinking strategically about that, and often providing new grants as a result, as more of a retention play, because the market that we're in now, there's a war for talent. So there's always another company calling on your employees. So there are things that companies are doing, whether it's through equity or salary, to try to maintain the talent that they currently have.
One more question from the audience. Apologies if we could not get to your questions. So the question is, do employees other than founders ever band together and negotiate the amount in terms of their equity, either at the beginning or later as new investors come in? Who watches out for the interest of non-founder employees?
Well, I haven't seen that. And employees' interest is usually, so high-level employees usually negotiate if they would like to get a promotion. It's same thing, right? If they think they're under-equitized, then they can bring it up with senior management. I don't see why rank and file can't do the same. So to the extent they feel like, based on their kind of market research, they feel like they're under-equitized, and definitely feel free to ask for it and just be prepared to provide your basis, right? And it's a purely commercial and economic decision, but oftentimes it's not top down as to like, oh, we need refreshers, the board kind of being kind and willing to take that dilution. It's oftentimes employees who essentially threaten to leave unless they get normalized in their equity position.
Final question for you. What parting words do you have for us? Dhirani?
I'd say if you're a founder or thinking about starting an entity, it's never too early to start getting professional help on keeping your cap table clean, and thinking about how you should structure your equity. You may have a great idea about, hey, we should do it this way, but seek professional advice, whether it's through a law firm, tax advisors, all of those together, before you make decisions that you have to either unwind or get you in a bind. It is money well spent, trust me, and it will definitely save you a lot of headache down the line. For an employee, I would say get yourself educated on equity and the tax implications of being an equity owner, whether it's consulting with a CPA, a financial advisor who understands equity compensation. It's very important that you understand how to reflect your views in the way that you interact with your equity. I've advised many people over time who said they were super bullish on a company and wish they could have done more, and they actually could have. They just didn't know what their options were and how to get the most out of their equity. So seek help. There's a lot of people out there who can provide advice to you that will save you a lot of money in the long run.
What I would say is what is customary in this space doesn't mean that's the right thing to do or the only way you could do it, but it goes a long way. This is where what is customary carries a lot of weight, and that's for the sake of efficiency and speed. And also that's because it's helpful from a risk management and cost perspective. So because someone has done it this way, and just based on the pure fact that that's what people are expecting, there is a convergence around certain things like 4-year monthly vesting subject to 1-year cliff. Just don't spend time negotiating that sort of thing if you don't have a compelling reason to deviate from it. That's just the way it is. And just if you have some goodwill to spend on that, I would probably spend it on something that is more meaningful to you, because venture industry, although it's like all about investing in innovative tech companies and open to new things, they're a very closed group of people, and they kind of think like a herd. So they kind of think the same way. So, but that's not a bad thing. So when people think about creative ways to get compensated, I want like post-termination exercise period of 10 years and all that stuff, fine. I mean, that may be a good idea, but in terms of, getting your package structured, I would encourage you to do what is customary and, tweak the parameters that often gets tweaked, like compensation and that sort of thing, instead of trying to get like, oh, I would like phantom stock versus options. So that's probably not something I would encourage ordinary people.
Thanks very much, Dhirani and Sale. That was a lot to cover, and you barely scratched the surface of the topic of startup equity. We really appreciate your time and insight.